In Kenya, we had Senator, which is our biggest volume product, was subject to excise tax from Q2 onwards, and we saw volumes fall by 85% as consumers decided that they didn't want to pay the price including excise tax. So they went into different forms of alcohol, and we kind of lost a lot of volume as a result. So given that experience, growing by 6% was something that we were very happy with. In our export markets, we grew also by 6%, even though we had a couple of headwinds there as well. We had some kind of trouble servicing the duty-free market. We had an airport burn down. We had one of our duty-free operators came up with some kind of cash flow challenges, which meant that we had to restrict supply. And also South Sudan, where we've opened a depot now, but the troubles in December really dampened volume overall in that market. So our export volume and revenue was pretty pleasing given those circumstances. The disappointment for me from a geographical perspective is the Tanzania business, where we implemented some restructuring in our route to market, and we saw revenue fall by 11% during the first half of the year.
Let me take you back on something you mentioned with regards to Senator. How upsetting was it for you when the government decided to implement the duty on that particular product, and how are you mitigating?
We were disappointed that the government chose to put excise tax on Senator because Senator has been developed specifically to encourage consumers to stop drinking illicit alcohol, which might be harmful for their health, and to give them a quality assured low cost offering as an alternative. And you know, we'd built that product up over a 10-year period. We'd invested over 5 billion shillings in capital expenditure, either in the kegs or the taps or the kegging line in the brewery, in order to service that route to market and those consumers in the lowest cost possible way. And we knew that those consumers were very price sensitive. I think the government has been surprised by the response of consumers to the price increase, because if you remember back to the budget, the announcement was we're applying excise tax on Senator Keg in order to achieve 6.2 billion of revenue. Because the volumes have fallen by so much, there will not be anything like 6.2 billion shillings of revenue. Well under a billion is our forecast.
During the full year, when I spoke to the financial director, one of the key things that came out with regards to the other markets that EABL operates besides Kenya is that they're softening in Uganda. But this time around, you're seeing a 17% organic growth jump. What led to this? How did you achieve this?
We've worked really hard to make sure that our brands are healthy, so the equity of our brands is such that consumers choose them more often than maybe they chose them in the past, and they choose them over and above alternatives, so our competitors' brands. And an example of that would be Uganda Waraji. Uganda Waraji is Uganda's largest spirit, and we'd seen an erosion of brand equity on Uganda Waraji over a number of years as we had underinvested in that brand.
Crossing over now to Tanzania, we saw an 11% drop, as you mentioned earlier, and you did mention also that for every 10 beers, 7 are from the competitor. What are you doing about it?
Our challenges are that our brands are smaller than the competitions. Our challenges are that from a route to market perspective, we had been disadvantaged. What we're doing about that is, we've talked about the route to market changes. We're moving from having a supply route which is through what we call stockists, which stock everybody's brands. But because 7 out of 10 of all of the purchases out of those stockists are from the competitor, those stockists are more likely to respond to requests and incentives from the competition. So we thought we were disadvantaged because we were being kind of carried as a service line rather than being kind of developed by those stockists. So we've moved away from stockists and into what we call distributors. And the distributors are dedicated to owning our brands.
In January, you did launch a commercial paper of about 5.4 billion shillings. How was the uptick in the market?
Yeah, so the CP program was oversubscribed. We've got facility for 5.5 billion, 5.4 billion. We wanted to raise about 3, but actually, because we had so much interest, we've actually taken about 4, just short of 4, 3.97, I think it is. So we were oversubscribed, and that gives us a lot of confidence about the market here in Nairobi. It's replaced some of our other debt, but the interest rate that we're paying on that is less than some of the alternatives. So it's good for us.
In H1, we saw some of the gains being offset by some of the challenges that you did mention earlier. So what can we expect for your full year performance?
Yeah, so we don't give kind of dark guidance, but I can tell you that because of the growth of across our spirits portfolio, because of the very strong performance of our premium brands and our mainstream premium and mainstream beers, we're very optimistic about H2. We've got quite a bit of work to do to optimise to mitigate the impact of the Senator. We've got to carry on kind of working hard to turn around the SBL business performance. But notwithstanding those things, we're in good shape. And I hope that at the full year results presentation, we'll have a conversation. You'll be commending me on the fine performance of the business.
Single digit?
I think so, yeah. I think if we didn't have Senator impact, we would be kind of mid-double digits, but it'll be something in the singles, I think.